Welcome to the deep dive. We get the sources, you get the crucial knowledge, fast and focused, no fluff. Today, we're diving into the second issue of a magazine called Aswell 9 For You Market Pulse. It's issue #002, dated October 1st, 2025. And their mission, right out of the gate, is pretty clear. They want to, elevate the trading conversation in the MENA region.
Yeah, push it towards a more scientific, evidence-based approach.
Exactly. They're saying, look, you got to get beyond just basic chart patterns. Think macro, sentiment, institutional flows, the real drivers.
It's deeper stuff.
Right. So our plan today is to pull out the key insights from this issue. We'll look back at September 2025, which they frame as a really pivotal month.
A turning point, definitely.
We'll tease the market reactions, some global risks they cover, and importantly, dig into some specific tools and investigations from their community sections. Actionable stuff.
And that theme for issue #002, it really hits home. September was the month the whole financial picture seemed to shift. Central banks going different ways, geopolitics heating up. You really needed to reevaluate things. If you didn't adapt your thinking, then, well, Q4 could be tricky.
Okay, let's unpack that pivot. The magazine's major financial events section kicks off with the biggest one.
Yeah.
The Fed's move, September 17th, 2025. So the actual move was a rate cut, 25 basis points.
Right, dropping the Fed funds rate target.
Yeah, down to that 4.00% to 4.25% range. But the why is the key thing here, isn't it?
Absolutely. It wasn't just a minor adjustment.
It felt like a fundamental shift. The Fed basically signaled, okay, maybe we've done enough on inflation for now. Let's worry about the job market.
Which was clearly cooling. Job gains slowing, unemployment ticking up. Was it 4.3% in August?
That's the number they cited. So the priority shifted from inflation fighting to, well, maybe supporting growth a bit more.
And that move looks even bigger when you set it against what other central banks were doing. The magazine really hammers this central bank divergence theme.
Like the ECB, they acted just before the Fed, right? September 11th.
Exactly. While the Fed's getting ready to cut, the European Central Bank holds rates steady, kept them at 2.00%.
And the messaging was different, too.
Totally different. Lagarde, the ECB president, basically said the disinflationary process is over. Huge confidence signal there. They felt they were on track for their 2% inflation target.
Okay, so Fed cuts, ECB holds. What's the so what for a trader?
Well, suddenly you've got this massive interest rate gap opening up. What is that? 225 basis points difference between U.S. and Eurozone rates?
That's huge.
It became the dominant trade idea for September. The money flow was immediate. People piled into the euro against the dollar.
And the magazine shows the result?
Yep. Euro USD strengthened by 2.1% just in September. The macro logic played out perfectly. If you saw that divergence, you saw the trade.
Which leads us nicely into how markets reacted overall. The market sentiment analysis section covers this. You'd think a rate cut might spook stocks, right? Signal weakness.
Sometimes, yeah. But not this time.
Global equities actually did really well. The S&P 500 gained, 3.58%? That's strong, especially for September, which is often a weak month historically.
Defied the usual September slump.
And the magazine explains this with the idea of a Fed put revival.
Pretty much. Investors interpreted the cut as the Fed stepping back in, providing a safety net. Lower rate expectations boost valuations, make borrowing cheaper. Classic risk-on signal for stocks.
Okay, so stocks liked the cheaper money narrative. But what about crypto? The ultimate risk asset, you'd think it would fly.
But that's the twist the magazine points out. Crypto did not follow stocks. It fell victim to what they call the crypto's September curse.
Seasonal weakness.
Seems like it. The total crypto market cap dropped by a massive $162 billion. Bitcoin itself lost over 5%, 5.2% to be exact.
So, wait, Fed eases, stocks rally, but crypto tanks. What does that tell us?
It's interesting, isn't it? It suggests the market maybe wasn't seeing the Fed cut as just a simple risk-on-everywhere signal.
Yep.
Maybe it was viewed as support for the traditional system, while crypto faced its own headwinds regulation, maybe. Something else.
Yeah. The easy money didn't lift all boats. That contrast is really revealing.
Definitely.
Now, let's shift gears slightly. Even with the Fed pivot, there were other major risks simmering. The major financial and geopolitical events section dives into this. One standout risk they highlighted was Russia's activity in the Baltic, deploying those Iskander-M missiles to Kaliningrad.
Nuclear-capable missiles, right on NATO's border. That's not subtle.
No, a clear escalation. How did markets react to that?
Panic. Not broad panic, interestingly. The reaction was very specific, very targeted. Investors basically said, okay, tensions are higher, who benefits?
Defense contractors.
Bingo! European defense stocks, like Rheinmetall in Germany, saw huge gains. The magazine notes Rheinmetall was up 12.5%. Investors were pricing in a long cycle of increased NATO defense spending, betting that this tension is the new, unfortunately expensive reality.
So, money flowing into defense, but what about the broader global economy, particularly China? The magazine flags ongoing struggles there.
Yeah, the manufacturing PMI figures. Still below 50 in September, which means contraction.
And that was the 5th month in a row?
Fifth straight month.
So-
Stuck at 49.4. That's a real drag.
Why the struggle?
Seems like two core issues. According to the analysis, weak domestic demand, Chinese consumers just aren't spending enough, and the hangover from the property crisis, which is still causing problems.
Right, property used to drive so much activity there.
Exactly. So China's big effort to shift towards consumption-led growth, it's proving really difficult. And that slowdown matters globally for supply chains, for commodity prices. It affects everyone.
It definitely creates uncertainty. Okay, let's move from the big picture macro and geopolitical stuff to how actual traders are navigating this. This is where the community corner and technology and tools sections come in. They seem really focused on practical, usable insights.
Yeah, this is where the magazine gets really hands-on.
Take the Traders interviews. They profile a trader named Zaid. He's a cybersecurity analyst by day.
Right, and he's applying that analytical rigor to his trading. He actually built his own tools.
Like the Tanit indicator, it uses something called a Kalman filter.
Yeah, which is fascinating. Kalman filters are all about signal processing, cutting through noise, used in aerospace, navigation, sophisticated stuff. He's applying it to price data.
Trying to find the real trend beneath all the market chop.
Precisely. Noise reduction for traders.
And he didn't stop there. He built another system, AlgoFar, an AI thing.
AI augmented fundamental analysis. It uses different AI agents, like one specifically trained as a COT analyst.
So it analyzes the commitments of traders report, institutional positioning.
Exactly. And another AI acts as a risk manager. It's like having a mini quant team built by an individual trader. Pretty impressive.
Very.
Then there's another trader, Nidahal. Younger guy, had a bit of a rough start.
Yeah, the magazine tells his story. Lost a funded account, spent $900 on a course that didn't help much. Relatable for many, I think.
So what changed for him?
Discipline and process, basically. He started using AI tools, like Grok, but in a very structured way.
How so?
He uses AI prompts before looking at charts to establish a strong directional bias, like today is buy only or sell only, based on synthesized macro and sentiment data.
Ah, so it forces him to have a high conviction view first, removing the guesswork at the chart level.
Exactly. Takes the emotion out, makes it systematic. That's how he turned things around, according to the interview.
Okay, this next section really speaks to the magazine's scientific approach claim, the Enna Detective section. They investigate common trading wisdom.
Yeah, they put things to the test with data. In this issue, they tackled a giant of technical analysis, the head and shoulders pattern.
Everyone learns that one, right? The reversal pattern, 2 shoulders, a head, break the neckline.
The absolute classic. Theory says it's a high probability short signal after an uptrend or long after a downtrend.
So what did the detective do?
They built an expert advisor, a trading robot, to trade the pattern purely mechanically, exactly as the textbook describes it. No human judgment.
Across different markets, over a long period.
Yep. 5 years of backtesting across major Forex pairs and gold.
Yeah.
Stripped away all subjectivity.
And the results?
Well, they were brutal. The mechanical strategy didn't make a profit on any instrument tested.
Yeah, seriously.
None. And the gold backtest was catastrophic. Started with $10,000, ended with 15.31 cents.
$15?
And 31 cents. A drawdown of 99.9%. Basically wiped out the account.
Wow. That's a pretty strong piece of evidence against relying only on visual patterns without context or confirmation.
It's a huge lesson. What looks obvious in hindsight often fails miserably as a purely mechanical rule. Data beats dogma.
Couldn't agree more. Okay, let's quickly touch on the technology and tools section before we wrap up. What caught your eye there?
2 things stood out. First, the launch of Robinhood Social.
The social investing platform.
Yeah, but the key feature they highlighted is transparency. Every post someone makes has to be linked to an actual trade they made on Robinhood.
Oh, interesting. So you can verify if someone talking up a stock actually owns it.
Exactly. A potential step against, pump and dump schemes and just general misinformation online. Accountability.
That could be significant. What was the other thing?
Quantum computing in finance. It's not sci-fi anymore. HSBC used IBM's quantum tech
Really? For what?
to improve bond pricing predictions. and they get a 34% improvement. That's a massive edge.
34%. Okay, so Quantum is actually starting to deliver real commercial results in finance now.
Looks like it. It's moving from the lab to the trading floor, so to speak. Firms need this tech to stay competitive in complex pricing.
So recapping issue #002 of AS194U Market Pulse. It really covers a lot of ground, from the huge Fed pivot and geopolitical risk,
To individual traders building custom AI tools.
and data-driven investigations that debunk old trading myths. It definitely delivers on that promise of a deeper, more evidence-based conversation.
Agreed. A really valuable read.
Okay, so for everyone listening, here's how you can get your hands on this. You can download our magazine for free at aswan9mag.com. That's ASWA-MRES.com. The magazine is available in 3 languages, English, French, and Arabic, and it is a monthly release. In addition, a monthly podcast discussing the magazine is published on our YouTube channel. If you're passionate about finance, follow our TikTok channel, In a Trader Hub. And finally, if you seek for a pro-grade community of traders to exchange idea with and to learn trading in a scientific approach based on data and not on dreams and imagination, you can visit our website, anytrader.com, to learn more about us and how you can join our community.
So based on the magazine's take that this September cut wasn't just a one-off, but likely the start of a whole new easing cycle. Here's something to chew on. What underlying structural changes out there, things like AI boosting productivity, maybe changing demographics, or these ongoing geopolitical issues, which of those do you think will ultimately decide where the Fed's long-term neutral rate actually settles? The rate that doesn't speed up or slow down the economy. Where does that end up in this new world?